JBlog, 28th of August 2011. So Irene has passed over New York City and has left a whole bunch of water behind, and of course has left that part in disarray. Generally, it doesn't seem to have been as bad as it could have been, but it's a good thing it has passed anyways, and probably will have little effect on the day-to-day lives once things are restored. Of course, it will have an economic impact. Whether it's a good impact or a bad impact, we're not quite sure yet about, but it will have an impact. And this is not necessarily a good time to have a bad impact. Looking at one of the charts that I noticed a little while ago is the ECRI, which is pretty good at predicting economic future, i.e., recessions, has had quite a substantial dip here in August. So that's quite significant, and there's basically a lower low. So this is definitely turning out quite bearish, which is something to be worried about. Going over to the news side of things, a few articles that I came across that I thought were well worth the read. One of them here is The Empire at Dusk. Talks about defense policy, defense spending. Very, very good read. I highly recommend reading that. And the other one that related is basically has the bloated security budget made us safer? And the US government spent $8 trillion on counterterrorism since 9/11. And the question is, what has that brought us? Are we actually safer than before? Again, a very good read. You can agree or disagree with it, I don't care. But it is a good read. Good story from Jay Taylor. He has a radio program turning hard times into good times. This one once again deals with the Fed, the Federal Reserve. There's an author that wrote The Creature from Jekyll Island. He's being interviewed in this. This is his second interview on this show. Well worth listening to. So I highly recommend just look up Jay Taylor and you'll somehow get to this interview. Well worth the listen. US, of course, is now pouncing on S&P and to see whether they can find some dirt on S&P after the downgrade. So if you go after the empire will go after you. A very sad state of affairs in a nation that is supposed to have freedom of speech. We'll see more of that. I imagine the more desperate the government will get. And desperate they will get for sure. One of my favorite writers, John Malden, his new letter has a few very interesting charts in it. Here is a real GDP chart going all the way back to 1948, and in colored red is all the recessions. And you can see here there's definitely turning over. The idea is that we're going to be in recession by 2012, perhaps earlier than that. And the last GDP number that came out is certainly confirming that as a fact. Another similar chart in the same article is sentiment. Michigan sentiment versus GDP. Sentiment seems to be leading GDP. So once again, another indication that there's a very good chance that we're going to dip back into recession territory from here. And there's a few other charts in this article that are interesting. This is basically how much debt the different countries in Europe are holding. The article talks about Europe and then who actually owns that debt, and Germany owns a lot of that debt. So the idea is that if those countries that owe so much to Germany do default, that will have a major hit on Germany itself, and with it that will hit the world. When you look at economic realities, you have to look at more than just one thing. Um, Interesting headlines I come across from time to time, and I usually use MarketWatch as a contrarian indicator. So here was one that talked about Apple outperforming gold. That was funny. And the other thing that was funny on the same page is who is to blame in the dip uh, stalemate, and half blame it on the Republicans and half blame it on the Democrats and half blame it on Bush, and the taxpayer or the voter bears very little responsibility, which of course is a complete denial. Once again, it wasn't me kind of thing. What else do we have here? We had a headline that says "Run for cover." The Dow, of course, was did a nosedive in the last 2 weeks, which sort of told me. Uh, First of all, here's a little survey that they did: is what did you actually do? And 22% had sold most of their portfolio. 20% are nervous and trimmed some other holdings. 20% bought some more, and 40% are just sitting there and they're not sure why, which is a good indication that we're not done yet. But in my opinion, we are currently in a little rally, just because there's always a snapback rally, but that could very well be over in the next couple of weeks. Another thing that came across here is speculations that gold could go to 3,000. Of course, it'll go to 3,000. We know that, but I don't think it's going to be by the end of the year, as some people are predicting, or even by the end of next year. I wouldn't necessarily bet on it. It will happen, but lots of other bad things would have to happen before that. Talking or just looking at the markets themselves. Here we're looking at the commodity index that tracks different kinds of commodities. Commodities definitely starting to take a downturn here, which is indicative of BRIC nations using less now than they had in the past. China had been is spending, I believe, at this point more than 50% of its GDP on infrastructure. And that, of course, can't last forever, and that's not real consumption, that's fake. Um, so that will have a hit on commodities themselves. Oil has had a substantial drop, which is good and bad. Um, but basically, it signals that there will be less oil consumed. Again, that tells us about China and India, that things are indeed slowing down. The gasoline wholesale price has gone down, which indicates that people are driving a bit less. Gold, of course, had a big run up. I was looking at this chart last week and I said this looks very parabolic. I actually went short at 1800, then I had another short at 1875, and then rode it out and actually covered my short down here somewhere close to 17. I was quite happy. That then went long. Currently I'm flat on gold. I'm not exactly sure where it's going to go at this point. I'm just gonna wait and see if I can make some more sense out of it long term. The VIX, of course, suddenly bounced up dramatically, and there's lots of fear in the market here. Again, this much fear. I started buying into a snapback rally, but the snapback rally is a temporary thing. One chart that is of interest is copper. Copper basically dropped and did not have the snapback rally. On Thursday and Friday there was a tiny increase, but not very much. So again, the metal with a PhD in economics is telling us that not all is well. So again, we need to pay attention to that. And now looking at the markets themselves, this is the New York Composite, and it had this big drop. It went up, it went down. It's very hard to trade this. I take very small positions at this point and just dabble a little bit, but even small positions rack up a lot of points um, as they as the market is just crazy at this point. I expect that once this has worked its way out, after we have a bit bit more of a rally, maybe another week, maybe 2 weeks. There will be worse news in September, and I think there's a good chance that we're going to take out the 2008 lows and go further than that. We'll have to judge that on a day-to-day, week-by-week basis. But at this point, I do not think we're anywhere out of the woods. If we actually do fall into recession, another 30% downside is quite possible. I do not see that as being impossible. Let's look at the core sectors quickly here. So the S&P 500 we've already looked at. Materials sub-index is pretty flat. It had, of course, given us a bit of a head and shoulder here, and then it dropped off. Next one is the energy sector. Again, same picture. We're looking at the financials. Financials look dreadful. Of course, the US banks have a large exposure, not so much to European debt, but they wrote a lot of the insurance that is written on European debt. And if a lot of those countries default, which they might, then US banks will be on the line for that. And as you can see here, for example, the exponential moving average 1030 has not had a crossover yet, so this market is definitely bearish. Industrials look bad. Technology looks bad. It's basically all the same chart. Consumer staples a little bit stronger, but still not very strong. Utilities, not bad. Actually had a fantastic rally on the utility side of things, which is a defensive stock. Again, that kind of tells us that there is a recession coming and money is moving into the defensive stocks. Healthcare, not doing so well. And consumer discretionary, of course, has dropped way too late for me. I bought some options that expired. So this has fallen too late for me, which once again shows that you can be right and lose money at the same time anyways, because things frequently go a lot further, a lot longer than you would expect. Anyways, that's my take on the market. I'm sort of slightly very short-term bullish, with 1 or 2 toes in the water, but ready to jump anytime if I see anything bearish, and I expect that things will get a lot worse, and I wouldn't be surprised by September that things will be a lot worse, because that's usually your month that is the worst month in the year. So we'll have to see. So I prefer to trade on the long side just a little bit, but I'm ready to jump short any day. All the best next week. Hope the New York Stock Exchange did not get damaged in the hurricane, so that I have something to do tomorrow. And all the best. Make lots of money. Bye.